Yeah, I mean, the thing about inflation too is it's not obviously normal inflation is a part of society, and deflation is actually a bad thing. There are some winners from inflation, and we talked a little bit about winners and losers, and I think it's something that we should bring up. Yeah, and I think, and then obviously July brings us into our next thing, inflation. Finally got a little bit of a tick down in inflation, which we talked about a little bit last time on the podcast. That we thought it might be peaking. Again, you're never sure. You have to see month to month. But July had our first downtick, and you can see from the chart. This is a 20-year chart, so this isn't 6 months or 3 years. Inflation's very high right now relative to what it's been in the past. But you can see at the very end there, just a small tick downward. And we talked about if we get a little bit of inflation relief where investors, the market feels like inflation has peaked and it's going to start moving the other direction, we're not going to see late 70s type inflation, then the market should rally a little bit. And that goes to Chris's point that we've had our best July in a long time.
So I think that's a lot what we said too, just in client conversations that have come up. And I know we hinted at it the last call here, but that was one of the things that we were looking for from a market indicator and just sentiment, like consumers starting to see inflation slow. And some of the meetings we've had the last week, you're not going to see it necessarily at the pump or at the grocery store today. It's not going from mid 8s all the way down to 3 again, but that downtick is kind of just that positive that it's slowing or coming down. And that's why we've seen a lot of the rally that we have seen the last couple weeks in the markets here.
Yeah, I mean, the thing about inflation too is it's not obviously normal inflation is a part of society, and deflation is actually a bad thing. There are some winners from inflation, and we talked a little bit about winners and losers, and I think it's something that we should bring up. Fixed rate borrowers. If you have a house and you've got a mortgage, obviously that's at a certain rate. Typically, if you're on a 30-year fixed or a 15-year fixed, and then the amount's fixed. So you got two things fixed, and you got dollars, and rates going up. So that's a positive thing. If we're in an inflationary environment, being an existing borrower is a positive thing. Other things, Jason?
Well, I also noticed too is as rates go up for our bond investors, that typically as I kind of described with some clients, being on the escalator is not so much fun, as we see a lot of bonds get repriced. But once we get off on the new floor, a lot of our fixed rate investors, I mean, many of our older clients can remember back in the day when they used to have a 5% CD. And we've been in such a long drawn out period of time where a CD rate was at, maybe 0.5% or even less than that. And now we're starting to see some higher rates come through. So for a lot of our fixed income investors, having a little bit of inflation, having some interest rates go up, it's uncomfortable for the moment. But once we get off on a new floor and the rates are higher, the bonds that they own, the bond funds that they own, CDs that they want to own, I've got some clients doing T-bills, things like that. All these rates are starting to pay a little bit nicer returns. So the older days of higher rates on those CDs might be coming back, which I know some people are looking forward to.
Yeah, and for 10 years, it's been challenging for lower risk investors to really generate a return, because obviously if you're lower risk, you're typically more in the fixed income side and you have a little bit of equity, but when your fixed income is paying you next to nothing, it's hard to generate any type of meaningful return for, again, lower risk, maybe older investors.
With the inflation too, the other thing that people need to be mindful of is that anything that's really priced in dollars, whether it's real estate, any kind of land, buildings, stocks, anything that's got a dollar denomination to it is going to be somewhat linked to inflation. If one were to look at the data going back, even on the Dow Jones, you might, or at least I've kind of broken it down with some clients looking at if long-term returns on the stock market, let's say, are going back to 1950, let's say there's 7 or 8%, something like that. I've broken it out in the sense where if the GDP of the country has not averaged close to that rate, but the returns of the stock market have. But if you've broken down the rate of return of the GDP and then you add inflation into it, of a historical inflation rate of, let's say, around 3%, almost 40% of your returns in the stock market have been just from inflation or the dilution of the dollar. And so by holding these assets and kind of avoiding holding cash, whether it's in land, in real estate, in stocks, and something, the inflation should drive up the price of all assets.
Yeah, so dollar-denominated assets, income seekers, fixed-rate mortgages, fixed-rate borrowers, all benefit a little bit from inflation.